A trader's account showed consistent progress for 8 months. Small daily gains, proper risk management, disciplined execution. Then came 3 weeks of choppy markets where the system produced 7 losing trades in a row. Not massive losses, just normal variance that happens to every profitable trader. Instead of recognizing this as statistical noise, the trader convinced themselves that their edge had disappeared. They abandoned the system that had been working and started searching for a new strategy. 6 months later, they quit trading entirely while their old system went on to produce its best quarter ever. This trader fell victim to the progress paradox that kills more trading careers than blown accounts or bad strategies. The closer traders get to consistent profitability, the more likely they are to quit because they misinterpret normal variance as system failure. What I'm about to reveal are the 3 psychological traps that destroy trading careers right before they would have become successful. Every profitable trader must pass through a psychological phase where their developing skills create expectations that temporary market conditions can't fulfill. Your edge works for months, building confidence and consistent returns. Then markets shift into conditions where your system doesn't perform, creating a gap between your expectations and reality that feels like regression rather than normal business cycles. This valley occurs precisely when traders have developed enough skill to recognize profitable setups, but haven't yet developed the psychological resilience to handle periods when those setups don't appear or don't work. You know what good trading looks like, making the inevitable rough patches feel more frustrating than they did when you were completely clueless. Knowledge creates standards that variance can temporarily violate. The psychological trap works through competence-based expectations. When you've been trading successfully for several months, your brain starts expecting that level of performance to continue indefinitely. Market cycles that previously felt normal now feel like personal failures because you've proven to yourself that you can trade profitably. The success creates pressure that didn't exist during your learning phase. Most traders interpret the valley as evidence that they've lost their edge or that markets have changed in ways that invalidate their approach. They start tweaking their system, seeking new strategies, or adding complexity to solve what appears to be a performance problem. These modifications usually make things worse because they're optimizing for recent poor performance rather than long-term edge. Professional. Traders recognize the valley as a predictable phase that indicates progress rather than regression. They understand that feeling frustrated with temporary variance means their standards have risen, which is positive development. Instead of changing their approach, they focus on maintaining discipline during the difficult period while trusting that their edge will reassert itself when conditions align. Learning to navigate this valley without abandoning your system separates traders who eventually succeed from those who cycle through strategies forever. Developing traders often reach a skill level where they can identify profitable setups and execute trades correctly, but they haven't yet developed the patience to wait for only the highest probability opportunities. This creates a dangerous phase where increased competence leads to decreased selectivity, causing performance to deteriorate exactly when you feel most confident about your abilities. The syndrome manifests when traders start seeing potential setups everywhere because their pattern recognition has improved. Every chart looks tradable. Every pullback seems like an opportunity. Every breakout appears worth taking. This abundance of perceived opportunities creates overtrading that destroys the very edge that their improved skills could have captured, with more selective execution. Competence overshoot works through confidence-driven selection bias. As your ability to spot setups improves, your brain interprets this pattern recognition as validation that you should act on what you're seeing. The increased confidence makes you feel like you're leaving money on the table by being selective, when selectivity is actually the key to profitability with your improved skills. The psychological mechanism involves mistaking pattern recognition for edge identification. Being able to see potential setups doesn't mean all potential setups are worth trading. Professional traders develop this recognition ability first, then spend additional months learning to discriminate between setups they can identify and setups they should actually trade. This second phase of development often involves trading less frequently, not more. Recovery from competence overshoot requires deliberately constraining your trading activity, despite your increased ability to find opportunities. This means setting strict daily or weekly trade limits, raising your criteria for what constitutes a quality setup, or implementing waiting periods between trades. The goal is aligning your execution selectivity with your improved pattern recognition, rather than letting confidence drive overactivity. Understanding competence overshoot prepares you for the final trap that destroys careers at the moment of breakthrough. The cruelest psychological trap occurs when traders abandon winning systems during the exact period when those systems are about to produce their best results. This happens because breakthrough periods often begin with performance that looks worse before it gets better, creating the illusion that something is broken when everything is actually about to work perfectly. Markets operate in cycles, and profitable systems experience periods of underperformance before breakthrough periods of exceptional results. Traders who abandon their approach during the underperformance phase miss the subsequent performance that would have validated their entire journey. The abandonment usually occurs within weeks or months of when the system would have produced life-changing results. The pattern works through recency bias amplified by frustration from having invested significant time and effort into system development. When you've been working on your trading for months or years, temporary poor performance feels more significant than it actually is. Your brain weights recent experience more heavily than historical performance, making short-term variance feel more predictive of future results than it actually is. Breakthrough abandonment often occurs because traders mistake cyclical underperformance for permanent system degradation. They see a few weeks or months of poor results and conclude that their edge has disappeared, markets have changed, or their approach no longer works. In reality, they're often experiencing normal variance that precedes periods of exceptional performance. Professional breakthrough navigation requires understanding that systems often perform worst right before they perform best. This counterintuitive pattern occurs because market cycles that create difficult periods for your system often set up the exact conditions where your edge becomes most powerful. Instead of abandoning during these periods, professional traders often increase their position sizes because they recognize setup quality improving, even while recent results disappoint. The ultimate irony shows up when traders spend years developing skills and systems, then abandon them during temporary drawdown, periods that last only weeks or months. They quit trading entirely, convinced that consistent profitability is impossible, never realizing they were closer to success than they'd ever been. The breakthrough they were seeking was waiting on the other side of the exact variance they used to justify quitting.